Hello, in this video we're going to learn about Forex chart patterns. So basically chart patterns are just repeated systematic moves that happen over time in the Forex market. So that means these are moves that you'll be seeing over time repeating themselves. And the importance of understanding chart patterns is because they help you to understand market structure. Because at any particular point, the market is either bullish, bearish, or it's in a sideways trend. So understanding chart patterns helps you to be able to define the market structure at any particular point. So patterns will help you to identify whether the market is doing one of these things. Either price is in a continuation, meaning we had a trend and price is continuing to the direction of the trend, or price is forming a total reversal, or we're in a sideways movement, meaning price is neither trending upwards nor downwards. So we're going to focus on these types of patterns because these are the most significant ones that will help you in your day-to-day analysis, especially when doing technical analysis. You will easily come across these patterns. So we're going to start with the M pattern. So an M pattern is also called a double top simply because, as you can see, it has two tops. So that's the first top. This is the second top. That's why the other name of an M pattern is called a double top. It's a reversal pattern, meaning whenever you see an M pattern, price has been buying for a while and we are now anticipating that the price will start dropping. As you can see from this point to here, price was buying. Then we have the M pattern formation. So since it's a reversal, we want price to reverse from being bullish to now bearish. So an M pattern comes in two forms. The first form looks like this. We see here we have a very flat peak at the top. This is also another example of an M pattern, and the difference is just that here the peak is a bit slopey. It's not exactly flat as compared to this, but both of them are M patterns. And the most important thing is that you get the concept of how the pattern looks like. When trading an M pattern, you want to first identify the neckline. The neckline is this lowest point in between the pattern. So you come and you mark your neckline. You also come and mark the neckline on this other M because they're just traded similarly, but the concept is a bit different. So when trading the M pattern, you want to find your entry point because we are selling, right? So you want to find your sell entry exactly below the neckline, or rather anywhere below the neckline. So there are two ways that you could get your sell entry. First of all, price could play around here, maybe form a consolidation. Then we could have a further drop. That's one way that the M pattern will play out. Another way that it will play out, which is one of the safest ways to trade, is that you wait for this price to go and retest the neckline. Price to go all the way back, retest the neckline, then it now drops. So this is where you want to get your entry. Let's see an example with the live charts. This is AUD/USD on the 1 hour time frame. As you can see, at this point, you see price was buying from this point to this high. Then if you look closely, here we have a double top. You can just draw a straight line to make sure you confirm. Here we have a double top. Price touched this point and this point. So this is the first top, the second top. That's why we call it a double top. And you can also see the formation of an M pattern if you're very keen. Price from the first top to the neckline to the second top. Then price dropped all the way down there. But now since we've already identified the M pattern, which is here, we want to mark the neckline and see how we get the entry. The neckline is the lowest point here at the mid. So let's just remove this drawing. You come and mark your neckline here, which is this low at the middle of the pattern, or rather the center. So we want to find our entry anywhere below the neckline. So when this candlestick closes below the neckline, that is when we confirm that the M pattern is valid. So after confirming the M pattern is valid, we want to find our entry somewhere below. So price could retest here, or it could also fail to retest. In this case, price never retested the neckline. So your work is just simply to find any confirmation that buyers are strong. So here we immediately after the M pattern is formed, we have a long body candlestick here, and a long body candlestick signifies that sellers are strong in this market. The candlestick is also a Marubozu candlestick because to the downside we have no shadow. If you check carefully, we have no shadow to the downside. That confirms that there was no rejection to the downside, meaning that the sellers are strong. So you could immediately get into your sell trade here after confirming the sellers are strong, or you could be more patient. You could be more patient, I mean, after being more patient, we had a consolidation here, and after the consolidation, we had a breakout and also another breakout here. You could also have taken your trade at this point here after this breakout from the consolidation, or this long body candlestick, stop loss above the candlestick there, which is about 20 pips, risk reward of 1 to 3, 1 to 4, either way, both of them worked. Yeah, that's how you trade an M pattern. Next, we have the W pattern, which is also called a double bottom. It's the exact opposite of an M pattern. Comes in two forms. Here we have one with a flat base. We also have another type of W pattern with a base that is a bit slopey to the downside. Both of them are W patterns, and the W pattern signifies market reversal. That means that price was selling before, then the W pattern has been formed, so we are anticipating a price reversal from a bearish market to now a bullish market. Basically, when trading a W pattern, it's the exact opposite. So you have your neckline here at the center. This time it's the highest point in between. You also have a neckline, same thing here. You want to get your buy trade anywhere above the neckline. So after price has confirmed and broken above the neckline and you get a candlestick close, you want to get your buy trade anywhere above. Two ways to get your trade: either price will consolidate here for a moment, and then it will shoot up, or the other way, which is again the safest way, is to wait for price to retest the neckline. There are times that it won't retest, but if at all it does this, this is one of the safest way to trade the W pattern. After it's retested and you get your confirmation, you can now get your buy trade here and wait for price to move to the upside. Let's see an example on the live chart. When Euro is on the 1 hour time frame, price was selling here for a while. Then here at this low, we have a W pattern if you're very keen. Let me just draw it. You have your first bottom. Remember, the second name is also a double bottom. Then you have the second bottom here. I don't usually focus on the shadows, so I just use the body. Then you want price to close above this neckline. So here, that's where the W pattern ends. You can also confirm by marking the zone using this tool here, that point to this. So that's our W pattern. Remember, we've said when the W pattern is formed, we're expecting price to reverse. From being a bearish market, we're expecting it to now become a bullish market. And the most important thing is that we have to note where our neckline is. This is our neckline. So we must get our entry above the neckline. So you come and mark your neckline here, which is this point. And in this case, after price broke above the neckline, we had a retest. After having a retest, we had this long shadow to the downside, confirming that we have strong rejection of the sellers. Then we got a bullish engulfing candlestick here. Remember, we want to get our entry anywhere above the neckline. So we have a retest, we have a confirmation that sellers are weak, then we have a bullish engulfing confirming that buyers are strong. So because this engulfing has closed above the neckline, we can definitely get into our trade at that particular point. So it's a buy trade. So you can simply get into your trade at that candlestick. Stop loss somewhere above the candlestick, which is about 23, 25 pips. You give it a small allowance of 3 to 5 pips. Then, depending on your risk reward, the trade went over 130 pips. We move to the head and shoulder pattern, which is also very common. So it's basically derived from the human body, where you have a head and two shoulders. So basically, this is how a head and shoulders pattern looks like, something like that. So you have your head, then you have two shoulders, a left one and a right one. So let's see how you apply this on the market. On Euro USD, price has been buying for a while, but then here it formed a head and shoulders pattern. It's a reversal pattern. So when you see a head and shoulders pattern, it means price was buying previously. So it's reversing from being bullish to bearish. So this is the pattern. You can just mark it. We have our left shoulder, we have the head, and we get a second right shoulder there. Then price drops. So this is the neckline, which is the lowest. You look at the lowest point in between, the lowest point in between from this point to here. Here, the center, this is the lowest point. You use it as your neckline. So you can just come and mark that zone, put a straight line. So this being the neckline, you want price to break below the neckline for you to confirm that the head and shoulders is valid. So here price broke out to this red candlestick, confirming that it's valid. And we also got a retest, which is even the safest way to trade this pattern. We got a retest and we got a long shadow to the upside, which indicates that buyers have been rejected to the upside. So after getting that confirmation, you can come and get into your short trade with this after this candlestick closes here. And your stop loss on Euro USD, not more than 30 pips. Then price ended up dropping all the way over 90, 100 pips. It dropped even further. But the whole concept of getting your trade is on this head and shoulders here. Moving to the inverse head and shoulder, just as the name inverse. So it's definitely the opposite of the head and shoulders. So this is how it looks like. You have something like that. This is how the inverse head and shoulder looks like. So in this case, it's still a reversal pattern. So price was selling for a while, and then it formed this inverse head and shoulder. So we want price to reverse from being bearish to now bullish. Let's see in the chart. Looking carefully here, we had a price drop from this high to this low. But if you check at this low, we have an inverse head and shoulder pattern which has been formed. You have to be very keen to spot the pattern. But let me just draw it to make it simpler. You could start anywhere here as long as you can identify the pattern. That's the most important thing. You have your left shoulder, then you have the head, then you get a right shoulder here, and then price buys. So remember the concept that we want to identify the neckline, which is here. So I'll just come and delete the pattern, mark the neckline so that you can see where it is. So since price is reversing from being bearish to bullish, we want to buy, but we want to buy anywhere above the neckline. So don't forget that our patterns, here, this is where we had our shoulder, the head, then it came back here and we formed a right shoulder, and the shoulder ended at this point. So after the shoulder ending, we just want to mark the neckline. Then we got a price retest, and after getting a retest, we also had a bullish engulfing, here, which confirms to us that buyers are indeed strong and in control of price. So you want to get into your buy trade immediately after this engulfing. Get into your buy trade. On Euro USD, just the same concept, stop loss about 30 pips. And we had a successful price push to the upside of over 133 pips. We had a retest and further continuation. But this is where we got our trade based on the inverse head and shoulders. We move to the consolidation pattern. It's a pattern which basically indicates that the market, or rather price, is in indecision, meaning price is neither moving to the upside or to the downside in a continuous trend, but price is in a sideways trend. So a consolidation will be more valid, especially when it's used for a continuation. That means price was either trending to one direction, then we get a consolidation, then we get a breakout, confirming that price should continue moving to that direction. Let's see an example in the live charts. On AUD you can see that the trend is definitely bullish. Then here we get a consolidation. So you can just mark that with a rectangle so that you can see that clearly. We get a consolidation showing that price has, it neither has bullish nor bearish momentum. That's why we say that the market is in indecision. Then we get a breakout to the upside, and then price continues moving up. Also, if you continue monitoring, at some point you also had another consolidation here. Price go to this point. So first of all, you need to identify that price already is in an uptrend. So we've already identified the general direction. You can see for yourself that price is forming higher highs and higher lows. So price is in an uptrend. So when you get the consolidation and the breakout to the upside, it's just a confirmation for us that price is continuing to move to the direction that we are anticipating. So that's a very good chance for you to take a trade. Like here we had a consolidation, then we get a breakout. After getting a breakout, you want to get any confirmation that indeed price is heading to that direction. So because we want price to be bullish, here as you can see we have candlestick that closed with a long shadow to the downside, showing that sellers are being rejected and buyers are the ones who are strong. After a while, we also got another candlestick, which is a long body bullish candlestick, confirming that buyers are strong. So after that candlestick, you might want to take your buy trade because we have all factors in place to confirm that this market is a bullish market. But don't forget the fact that we got our trade based on the consolidation, but we just combined with other technical factors before you can take your buy trade. So that's how you trade a consolidation. It could either be a breakout to the upside or to the downside, but it's important that you first have an anticipation or a clue of the general direction, especially from the higher time frames, so that you can trade your consolidation on the lower time frames. Lastly, we have a wedge. So a wedge is just a pattern that forms when two trend lines converge. For example, when we have one trend line like that, then we have another trend line converging. It could touch it like that. It could be a wedge. It could fail to touch it. Anything like this, it's called a wedge. So whenever we have a wedge, it also signifies that the market is in confusion. We have price indecision. So you wait for price to break out from the wedge, either to the upside or to the downside, based on the market behavior. So these patterns are not very perfect. It's just upon you to understand how they look like, then you can apply them based on your analysis. But always remember to start focusing on the higher time frames before you can validate these patterns on the lower time frames. So it doesn't matter whether the breakout is to the upside or to the downside. If it conflicts the higher time frame analysis, then that trade or rather that setup isn't valid at the moment. So here we have Euro. For example, this is how a wedge looks like. You could easily spot a wedge with more practice. For example, here, if you look carefully, we have a wedge. We have two trend lines that are converging. So that's a wedge. Then we get a breakout to the downside. You look for further confirmation, and we had a smooth sell trade. So I'll keep insisting for you to be able to understand these patterns, you need to do lots of practice because often people ask me how you're able to understand all these patterns at once. But there's no secret, you just have to do lots of practice. For instance, after learning these patterns from this video, it's upon you to open your charts and to do back tests. When doing backtest, it simply means you use the past data. So you might want to open your chart and scroll back, scroll through the past data and try to identify these patterns over and over. Also, another thing, whenever you're starting a new Forex week, you can give yourself a target to, let's say, you can say that this week I want to specifically focus to identify M patterns or head and shoulders. So identify the pattern and try to take the trade based on the concept, how you've learned it. Just do consistent practice until you're able to get the pattern in your fingertips. Otherwise, that's I hope you've learned from the video. That brings me to the end. I'll do another series of videos explaining each pattern, to give more in-depth information.